Howdy, Team 42. It's your skipper here, Darius Dale, to present our Around the Horn Weekly for Saturday, September 11th. Just want to stop before we get going and just thank our military men and women, our servicemen and women, the families, and anybody who was a hero contributing in any form, shape, or fashion to the heroic efforts that we saw in one of our country's most tragic days. So we just want to thank you guys and appreciate everything that you do to help us do what we do. We couldn't do without you. So thank you. Just getting right into the content here, starting with slide 3, looking at the key takeaways. Goldilocks. Oh, and by the way, it looks like I'm in this well-furnished prison room. I'm not. I'm in an Airbnb in Ann Arbor, Michigan. I'm up here to see a football game. My hometown Washington Huskies are taking on the Michigan Wolverines. My first trip to the big house, so I'm pretty excited about that later today or later tonight. If you guys have any food recommendations, please send them my way. Hit me up on Twitter and let me know. I want to stop and get some good grub before we get out of here. But anyway, back into the presentation, because you obviously didn't come here to follow me and watch me eat. Anyway, starting with the key takeaways on slide 3, Goldilocks remains the dominant market regime with 22 confirming asset market BAMs, contributing to its 35% modal outcome market regime probability. BAMs is short for volatility adjusted momentum signals for those of you who are new, and we do thank you, appreciate you for subscribing. Number 2, today's 62 reading for total confirming asset market BAMs, the total number of signals across the 4 grid regimes, is only in the 74th percentile of the historical time series, and this is going all the way back to January of 98. That's suggestive of an investor consensus that is not fully positioned for the likely general persistence of Goldilocks over the next couple of months. Notwithstanding, kind of the sell-off we saw to yesterday's close. We continue to observe sort of in our crowding analysis, or we continue to observe like the lack of sort of full positioning in Goldilocks via our crowding analysis, with the median eyeball premium across the 37 core ETF exposures we track at an elevated 42%. So that's about around where it was, the other side of OPEX last month in August, and so that clearly was a buy signal. Looking at our cross asset correction risk indicator, that's at 37%. That continues to suggest a meaningful correction in the SPY, i.e., anything greater than or equal to 8% to the downside. We see that as a low probability event over the near term. All told, no changes to our portfolio construction this week outside of our buying the dip in high yield credit. So we added some more high yield credit exposure to the portfolio construction on Friday afternoon in conjunction with our September macro scouting report. For those of you who check that out, for those of you who have not had a chance to see that yet, 150 plus slides of data-driven content. This is what we do here. We want to help you weaponize data to your advantage. Weaponize it. On slide 4, kind of just looking at our portfolio construction, just as I mentioned, highlighting the addition of high yield credit. We added that on Friday in the macro scouting report. So again, check that out if you get a chance. But really no big changes. Feel really confident and content with this portfolio construction both in the context of our bottom-up macro regime views in the economy, i.e. not slowing as fast as consensus is fearing. Inflation is transitory and likely to be transitory and decelerating. And moreover, you're unlikely to see a material change in monetary policy. And moreover, more importantly, net liquidity provision for at least another couple of months. So we like this portfolio construction setup. We also like the fact that we do have 20% cash, sitting on 20% cash. We're not fully invested. And part of the reason that we have some high beta exposures in there, like crypto, Ethereum, Bitcoin, crude oil, et cetera, Ireland. But the reality is we certainly think a lot of these exposures can and are likely to do well to the extent that this sort of near term, this another one of these sort of, kind of short term episodic and non-trending volatility events gets resolved to the upside. Slide 5, looking at our global macro risk matrix, nothing really to call out in terms of how we ended the week. We kind of highlighted the transition to neutral from a volatility adjusted momentum signal perspective. Friday morning in the leadoff morning note for the 10-year gilt yield. Maybe it's a harbinger of what could potentially happen in the treasury market, in the boom market, in the Swiss market. We'll see. I don't want to make too much of a statement out of a very nascent neutral signal there, but no real meaningful changes late this week. On slide 6. Looking at our global macro risk matrix, the market regime signals mentioned that total confirming asset market BAMs is only in the 74th percentile, in terms of, confirming Goldilocks. So we'd like to see that get up to, 90, 95% percentile before you really get concerned about investor consensus being too crowded into one of those grid regimes and kind of one of the big gains. Looking at the market regime probabilities, I mean, that's a jumbled mess over there to the right side of that chart. And that's exactly what you would expect to see looking at slide 7. Slide 7 just shows, when you cluster those dots near the origin, you start to, you lose the signal from the economy in terms of, perpetuating inter and intra asset class dispersion. And it really puts the onus on monetary and fiscal policy, as well as, crowded or uncrowded positioning as it relates to, kind of perpetuating asset market performance. So this is the world we live in. We got it, it was easy in reflation, in so much that it was super easy in deep deflation last winter, last spring. It was very easy to make money in both directions for like 18 months. And now, as we've seen over the last couple of months, this is where the pros are being separated from the Joes. You actually have to have a process when the signal becomes less clear, and you still have to make decisions. You still have to make decisions, even though the signal is less clear. And so it's my job. I take that with great responsibility. I'm grateful for the opportunity to partner with you guys and augment your process, because the reality is, not one of us could do any of this by ourselves. Obviously, we're all learning from each other, and I certainly appreciate the opportunity and the ability to contribute to the community, to the growing global community we built here at 42 Macro. And slide 8, looking at the dominant market regime, I highlighted this. I've been highlighting this for several weeks, if not several months now. But we expect Goldilocks to dominate as the dominant market regime, at least over the next 2 more months. In the context of our net liquidity dynamics view, certainly from a frequency perspective, you're going to get these intermittent bouts of deflation or inflation, but the reality is the asset markets are very likely, in our opinion, to trade like Goldilocks over the next, at least the next couple of months. We see the real meaningful downside risk in asset markets as a sort of, at the earliest, kind of a November, but most likely a December event, when you see the confluence of tapering out of the Fed. At the same time, you're likely to see a meaningful acceleration in Treasury debt issuance. So that, to me, is like the big red flag out there, and it could have happened sooner. But again, we're obviously looking at things like our CAC, which is at 37%. It's not quite in the danger zone yet. Now, again, when these things change, like if we're talking to you next week, CAC could be at 15, and total confirming asset market VAMs could be in the 99th percentile. And we're like, oh my God, like let's book this, and we got to raise a bunch of cash. But that's not the case this morning. What is the case on slide 9, looking at the CFTC futures and options data, net speculative positioning therein, and looking at the mean 3-year Z-score across the 26 risk assets in this table, and it's still 0. Not a ton of positioning in the derivatives markets with respect to risk assets. If you look at slide 10, our crowding analysis, like the mean, as I mentioned, the mean IVOL premium across the 37 core ETF exposures displayed in this table is at 42%. And so that's obviously quite elevated. And so, maybe, and this is something, I've been having conversations with a few of our protocol subscribers this week. And, we had this very consistent pattern of, asset markets selling off into monthly OPEX. And so, investors aren't dumb, certainly the buy side isn't. And the reality is you might actually start to see people start to front run that. So maybe that's what's happening this week. And I suspect you could actually see it spill over into the early part of next week. But so many, as we'll go through in a few slides, so many exposures in the portfolio construction and broader macro are oversold. So I don't see a tremendous amount more downside. But again, I think you could get a sloppy Monday, or sloppy Monday and a sloppy Tuesday morning open. But I certainly don't expect to see much more downside from there, considering how sort of how the limited amount of risk investors are taking. There's just not a lot of risk people are taking. You don't see it in CFTC data. You certainly don't see it in the options data in terms of the volatility risk premium data that we're tracking here for 3 months now. The sector and style factor dispersion has consistently screamed defensive exposure. So, I think when you add all those things up, you see you kind of can characterize a buy side consensus that has low net exposure or tight net exposure and meaningfully low gross exposure. A lot of people took risk off. A lot of people had decent years in the first half of the year and just kind of, I wouldn't say mailed it in. You never really mail it in when you're bolted to the chair. But the reality is, I don't think people are taking a lot of risk, and that is a positive dynamic if you're, to the extent that you believe that the lack of risk, insulates downside in these sort of kind of monthly OPEX correction type events. Looking at slide 11, this is the kind of the key data point of the week, in terms of the shocking asset markets to the downside, and kind of kind of, we punted tapering, a little bit further with this August jobs report, and now we kind of pulled it back with this PPI report. So obviously 8% PPI didn't help, but if you look at the annualized momentum, that kind of came in pretty meaningfully. Again, 1 month does not make a trend. Obviously, the year-over-year data points are still accelerating meaningfully. But when you look at the CPI data, you look at the core PCE data, the median CPI data, the Dallas Fed Trim Mean data, inflation momentum has waned. I wouldn't say markedly, but it's certainly noticeably waned in recent months, and that's something I'd call out as a supportive factor for risk assets, and kind of not this sort of bearish kind of oh my God, stagflation, Fed's got to tighten into a slowdown. I just think that may be the case later this year. I just don't think that's happening here on slide 12. Sorry, I mean, we don't think that's happening here. It's a team here at 42 Macro. So you guys don't get to see all the people who working hard aren't in front of the camera, but I certainly do and appreciate them, and they appreciate you. We all appreciate each other. Getting back to the data on slide 12, looking at the S&P 500, that's bullish, fams. It's oversold, as I mentioned. Again, you get going to the early week. It's not necessarily in the context of this heading into an OPEX week. I wouldn't be too quick to buy the dip. Certainly with a lot of these oversold exposures, but it probably means that you could see some sloppiness on Monday, maybe a sloppy Tuesday open, but in the context of everything entering the week oversold, it's suggestive that you're seeing some front running of that kind of OPEX episodic and non-trending volatility dynamic. Looking at WTI bullish FAMS, that's not actionable. Slide 13, looking at the US dollar and 10-year break evens, they're both neutral VAMs still. So you're not going to get a real meaningful signal from the perspective of asset markets if you don't have a real meaningful trend in the dollar, and certainly a meaningful trend in inflation expectations, which is, if you look at this chart, they haven't really gone anywhere in like 4 months. Just banging their head at the top of the upper boundary of the probable range, and that's something that you would expect to see in the context of inflation remaining high and sticky, but actually starting to disinflate as our model is projected this entire time. On slide 14, looking at the nominal 10-year, that's kind of just starting to do the same as well. Not breaking out, but certainly not breaking down anymore. It's kind of consolidating, and maybe the next move is higher to some degree. The next big move, rather, and what I mean by big move is I think certainly when you get into these, this sort of unfavorable net liquidity dynamics that we expect to commence, later this year, you could see, 10, 15, 20 basis points of backup in the nominal 10-year, but you're not going to get a meaningful, sustained, drawn out backup like what we saw in the first half of this year, because again, you don't have bottom up macro regime reflation perpetuating that. You're not going to have the signals from the economy telling investors they need to sell bonds. And that to me is a real key takeaway. So it's really mostly a technical dynamic, and technicals only get you so far. They matter. Certainly they matter in these kind of, sort of shorter term windows, but you're not going to get like this, going from 1.4 in the 10 or 134 to 234 in the context of inflation disinflating and growth decelerating. That's just not something you would expect to see. That's certainly not something that's certainly not something that market history would agree with either. Looking at high yield OAS, that's still bearish, fam. So again, don't freak out when you have these sort of sloppy closes on Friday. A lot of this, the options market dynamics that guys like Jim Carson speak to. I do believe that stuff is very meaningful. It's increasingly meaningful, if only because there's more and more people paying attention to it and kind of reacting to it. And I would argue this week front running it. But the reality is, when you see high yield credit spreads, bearish FAMs and breaking down, that's clearly not a sell risk signal. On slide 15, looking at the high beta, low beta ratio, that's neutral VAMs, not actionable. Looking at small caps, mega caps. So if you kind of start the week bad next week and you're going to you're talking about having this conversation at the end of next week, I would imagine small caps have staged a meaningful relative performance comeback relative to their mega cap exposures, mega cap counterparts rather. Slide 16, value to growth, neutral VAMs, that's oversold as well. VVIX fixed ratio, that's neutral VAMs, it's oversold. And so, again, I mentioned that we have a myriad of signals that'll tell us to kind of get to raise cash, get defensive. Obviously, going into a real fervent push, and what I mean by fervent push is into deflation or inflation, which are both risk-off regimes in our framework. If we've had a real fervent push with a tremendous amount of confirming asset market VAMs moving in that direction, obviously we would say, hey, no, this is a pretty meaningful signal. Again, the last couple of transitory deflation moves we've had, it's been like peekaboo with the signal lines, and I'm like, okay, I don't trust this. This doesn't feel right, and it obviously turned out not to be correct in terms of the transitory nature of the last couple of deflation scares that we've had in terms of the market regime signaling process. But if we had one where it's like, no, VIX is going to 25, higher credit spreads are going to 350, like that stuff's a lot more actionable. and a lot more obvious, and a lot more sort of, we'll do a lot more to react to that. But in terms of like the ancillary things that we're looking at that might get out ahead of those kinds of signals, it's the dollar breaking out to bullish FAMs. It's high yield credit spreads breaking out to bullish FAMs. It's the VVIX fixed ratio breaking down to bearish FAMs. You saw all three of those things occur in the same week or right around the same time. I think that's a clean cut sell signal, even before the rest of the asset markets kind of confirm a move to a more meaningful kind of bout of market deflation. So that's what we'd expect to see again later this year, a couple months from now. Who knows how long exactly what will occur, but I certainly don't necessarily expect that to occur anytime soon. And what I mean by anytime soon is over the next, kind of 6 to 8, 9, 10 weeks. On slide 17, kind of getting into the chopping of the wood of the portfolio construction. We'll be quick with this. Looking at defensives, that's bullish FAMs, it's oversold. Mega cap growth, that's bullish FAMs, it's nearly oversold as well. Slide 18, looking at size, that's bullish FAMs, oversold. Real estate neutral VAMs, so the volatility signal kind of got away from it there, but that's oversold as well. Slide 19, looking at healthcare, that's bullish FAMs, it's oversold. Same thing with Ireland. Same deal with Ethereum on slide 20, looking at both the digital asset and also the ETF. Both of those are bullish FAMs, oversold. Slide 21, Bitcoin, bullish FAMs, oversold, but you actually have, it's not big. The ETF GBTC is actually not quite as oversold as the actual digital asset is. So, in the context of, not necessarily worrying about the OPEX dynamics affecting, digital assets, I would imagine we see, pretty meaningful bounce in digital currencies next week and certainly in subsequent weeks, in the context, again, of our expectation that Goldilocks is the dominant market regime from a frequency, or dominates the dominant market regime title from a frequency perspective over the next couple of months. And again, if we're wrong on that, we have a myriad of signals that we're refreshing every day that'll get us out of that and get us to raise cash sooner than that. But again, this is part of the just sitting in, part of being bolted to the chair is you got to make a call, especially in weeks like this where you get the PPI data and market sells off into the close, and people, the questions are there, and the questions, this is when you need to trust the process, buck up, and make a call. And to the extent that you don't want to do that, you can certainly outsource that to firms like me. But certainly there's more ways than skin the cat. I certainly don't have it all figured out, never probably will. That's the beauty of this industry. You always get to learn something new. On slide 22. Looking at the Eurozone, that's bullish FAMs, oversold. WTI is not quite oversold. In fact, it bounced on Friday. That's another kind of stealth signal that, this, including high yield OAS, that's another stealth signal that, this isn't necessarily the start of the start of the beginning of the end, the beginning of the end of the equity market that everybody hates. Every article this week was like, oh my God, this new bank is bearish. That new bank is bearish. That new bank is bearish. CNN Fear Greed Index got a 4 handle on it. I mean, come on. Just look at the chart. Just pull up a 1-year chart of the SP 100. What are you waiting on? Okay, I guess everybody's waiting to buy the dip. On slide 23, materials, that's bullish FAMs, oversold. Same thing with financials. On slide 24, Barclays Act, that's bullish FAMs, nearly oversold. Extended duration treasuries, EDV, bullish FAMs still, but not actionable, not quite at the low end of its probable range. Slide 25, looking at EM dollar debt, that's bullish FAMs, it's oversold. TIPS is neutral. FAMs not actionable. Don't love how it's been trading in the last last few weeks. Definitely keep an eye on this, but the reality is, this is going to be one of those exposures that's likely to take some pain in the context of that because the Fed becomes such a meaningful major participant in the TIPS market, much more so than obviously the Treasury market. And so, this is something you kind of want to, pay attention to in the context of that signal, because I do believe it'll probably lead the broader kind of backing up of it again. When I say backing up of interest rates, if we saw a technically driven backup in interest rates later this year, in conjunction with the net liquidity dynamics shifting from extremely favorable now, very limited debt issuance, obviously the Fed's still 120 billion a month, to something that's obviously, much worse than that later this year, I would expect TIPS to be really kind of leading the way there. But again, that's an expectation. It's not necessarily, fermented reality. On slide 26, looking at treasuries, 20-year treasuries, that's bullish FAMs, not actionable. US dollar neutral VAMs, nearly overbought. So when that dollar goes, and by the way, I mean, it's starting to look like it's very narrowly kind of starting to make, kind of lower low, lower high. I don't know. I think I'm reading too much in these charts. That's kind of, that's what happens when you stare at a screen for 16 hours a day. You start to read too much in every little squiggly line. But the reality is, if this dollar is starting to move in the other direction, which is sort of, kind of implied by this, more hawkish shift and shift right with respect to Eurozone policy. And this is something we've been calling out. We said, hey, there's the Eurozone economy has more resilience than the US economy. The US economy is coming off a sugar high. It's coming, the Eurozone economy, never went to that sugar high. So they have a lot more organic demand that they can continue to burn through. And this is why our grid regime forecast suggests that the Eurozone economy will remain in bottom-up macro regime reflation for a couple more months longer than the U.S. Eurozone CPI, obviously, pushing to 3%, multi-year highs. I want to say 5-6 year high. I mean, that's a big number for them. So again, that's why you saw the hawkish policy shift at the margins out of the ECB. But the key takeaway from all that is that it insulates the breakout of the dollar. You're not going to get a big, meaningful correction in stocks or credit in the context of currency vol breaking down, the dollar not being able to break out, high yield OAS breaking down. There's a lot of these signals, irrespective of kind of the episodic and non-trending volatility that's associated with things like OPEX or these one-off, data points that scare, kind of scare the headline chasers. The reality is, you got to kind of, there's a real natural sequence to a lot of these big risk-off events. And that's partially why we look at all the things that we look at every day and every week to sort of get out in front of that and really, most importantly, beat the herd to the raising of the cash. Lastly, on slide 27, high yield credit, we, both J and K, we added HYG to get a little bit more of that exposure. They're both bullish fams and oversold. So off the dip in high yield credit, expect to clip some coupons ahead of it. We're picking up nickels in front of what we expect to be potentially a steamroller. Is it going to be the steamroller that last spring was, or last winter was? Is it going to be a spring roller that Q4 18 was? Who knows? Maybe it is, maybe it won't be. But the reality is, it's, if the steamroller is 2 miles away, it's a bit different than if it's 2 blocks away. And we would expect, based on our, bottom-up macro regime views, particularly in the context of an economy that's not decelerating materially, and inflation is disinflating modestly. Both those back tests have been historically quite positive. So I'm not concerned about the economy. I'm mostly concerned about what's changing at the margins in monetary and fiscal policy. And again, our expectations over the next 2 months is that it continues to be very favorable for the appreciation of risk assets. Therefore, that is why our portfolio construction reflects that. So that's me wrapping up our Around the Horn Weekly for Saturday, September 11th. Again, thank you guys for subscribing. Thank you all, our military men and our servicemen and women, for their service. We appreciate you guys. Thank you.